Welcome back. We are busy with Class 7 investments, and we are busy with Unit 2 in the basic investment component that we're currently discussing. In this session, we will briefly look at the various financial markets and instruments in terms of investment. Right, let's have a look at financial market. Financial market, from the name itself, are a type of marketplace that provides an avenue for the sale and the purchase of assets such as bonds, stocks, foreign exchange, and derivatives. Often they are called by different names, including Wall Street or a capital market, but all of them still mean the same thing. Simply put, businesses and investors can go to financial markets to raise money to grow their business and make more money, respectively. Some financial markets only allow participants that meet specific criteria, which can be based on factors like amount of money held, the investor's geographical location, knowledge of markets, or the professional or profession of the participants. If we look at the diagram on the next slide, just to give you an indication of what the total financial market comprises of, we'll see that you get the capital markets, the bond markets, commodity markets, money markets, derivative markets, future markets, insurance markets, foreign exchange markets. These are all part of the financial market as a whole. Financial market prices may not indicate the actual intrinsic value of stocks due to macroeconomic forces like taxes. Also, the prices of securities are heavily reliant on informational transparency to ensure that the market set efficient and appropriate prices. Financial markets can be found in nearly every nation in the world. Some are very small, with only a few participants, while others, like the New York Stock Exchange (NYSE) and the Forex markets, trade trillions of dollars daily. The stock market is a financial market that enables investors to buy and sell shares of publicly traded companies. The primary stock market is where new issues of stocks are first offered. Any subsequent trading of stock security occur in the secondary market. For the financial market to perform efficiently, information transparency is essential as it increases the confidence of participants. Interest rate contracts dominate the derivative trading market in South Africa. A financial instrument. An instrument is a tradable asset or a negotiable item, such as a security, a commodity, a derivative, or an index, or any item that underlies a derivative. An instrument is a means by which something of value is transferred, held, or accomplished. In today's financial marketplace, financial instruments can be classified generally as equity-based, representing ownership of the asset, or debt-based, representing a loan made by an investor to the owner of the asset, or foreign exchange instrument comprise a third, which is a unique type of instrument. The different subcategories of each instrument type exist, such as preferred share equities and common share equities, for example. Financial instruments are assets that can be traded, or they can also be seen as packages of capital that can be traded. Most types of financial instruments provide efficient flow and transfer of capital throughout the world's investors. These assets can be cash, a contractual right to deliver or receive cash, or another type of financial instrument or evidence of one's ownership of an entity. Now, there was reform of the financial sector regulatory system, and National Treasury then proposed reform of the sector in South Africa, and it's guided by 15 governing principles, of which the following are the most relevant for the financial markets. So we're only going to deal with a few of these principles, not all of them. Principle 1, financial service providers must be appropriately licensed or regulated, meaning that entry into the market must be subject to an appropriate licensing and or registration process depending on the type of financial services provided. No provider of a financial service should be allowed to operate outside of the regulatory perimeter. Principle 2, there should be a transparent approach to regulation and supervision, meaning that where appropriate, regulation and supervision should be risk-based. It also should be proportional to the nature, the scale, and complexity of the risks present in a regulatory entity and the system. Principle 3, the quality of supervision must be sufficiently intense, intrusive, and effective. The ability of the supervise requires appropriate resources, authority, organization, and constructive working relationship with other agencies, and must be complemented by the will to act. The will to act requires supervisors to have a clear and unambiguous mandate, operational independence, coupled with accountability, skilled staff, and a relationship with industry that avoids regulatory capture. Principle number 4, the government and the legislator set policies and legislation, providing the operational framework for regulators. It means that the policy framework should be transparently be via the executive. The parliament will appropriate legislative proposals. While regulators do not set policies, it is critical to clearly demarcate what constitutes policies and empower regulators to set a supervisory framework. Principle 5A, regulators must operate objectively with integrity and be operationally independent, but must also be accountable for their actions and performance. Regulators must therefore be empowered to work without fear or favor and be operationally independent within an approved legislative and policy framework. Principle 6, regulation should be of universal applicability and comprehensive in scope in order to reduce regulatory arbitrage, so that individual institutions or classes of institutions should not arbitrarily be exempted from regulations and supervision. Principle 7, the legislative framework should allow for a lead regulator for every financial institution that is regulated by multiple sets of financial regulators. All regulators involved must strive to coordinate their supervisory activities, as financial institutions are generally regulated or supervised by more than one regulator, often falling under different ministries. Regulators should be obliged to coordinate their activities formalized through legislation or a memorandum of understanding. The lead regulator must ensure that effective consultation takes place between the regulators and should not inadvertently undermine other regulators. Principle 11, market conduct oversight must be sufficiently strong to complement prudential regulation. And then the last principle, principle 15, the above principles are reflected in international standards like the International Organization of Securities Commission, IOSCO, to the extent that there are any contradiction or inconsistencies in the above principles, the international standards will then apply. We look further at the reform of the financial sector regulatory system. In consolidating these principles, the effectiveness of the SSA can be measured by how well it delivers on the three core objectives of security regulation, namely 1, protection of investors, 2, ensuring that markets are fair, efficient, and transparent, and 3, the reduction of systemic risk. These three objectives are closely related and in some respect overlap, as many of the requirements that help to ensure fair, efficient, and transparent markets also provide investor protection and help to reduce systemic risk. Similarity and similar measures that reduce systemic risk protect investors. It is essential to translate these broad objectives into tangible and meaningful protection for the financial markets. Right, let's have a look at the Security Services Act number 36 of 2004. SSA took effect on the 1st of February of 2005. It governs the regulation of security services in South Africa to include security exchanges, the Central Security Depositories or the CSDs, clearing houses and their respective members. It consolidates the South African regulatory framework for capital markets and aligned the regulation and supervision of South African financial markets with the current international development and regulatory standards. The SSA does not apply to collective investment schemes regulated by Collective Investment Schemes Control Act number 45 of 2002 or activities related by the FACE Act, which is the Financial Advisory and Intermediary Services Act number 37 of 2002. Now let's have a look at the role players in the financial markets. And the first regulator that we're going to look at is the Financial Markets Advisory Board. Now, the FMA advises financial institutions, regulators, and government entities on their most critical and often their most complex financial issues. They work with senior management at top financial institutions, official institutions, and market intermediaries and utilities around the globe with a focus on their balance sheet and capital market exposure, as well as a wide range of other strategic, regulatory, and operational challenges. The technology and analytical infrastructure help provide a unique value proposition for their clients. They leverage our Aladdin platform in addition to the firm's sophisticated capital markets, risk analytics, data management, and financial modeling capabilities to deliver results-oriented consulting and advisory skills. The FMA was established in 2002 to address the unique challenges that arose globally as a consequence of the financial crisis. Since inception, they have completed over 650 assignments for more than 250 unique clients in over 35 countries. Professionals are spread across geographic and time zones to serve clients in all locations and respond to urgent needs as they arise. For assignments demanding cross-disciplinary expertise, they unite professionals from multiple offices to deliver the most effective team for any client situation. The FMA operates behind an informational barrier, separating it from the firm's traditional portfolio management activities. It creates a confident, avoidant environment and further serves to protect client data and proprietary information. Right, if we look at the next regulator, which is the Financial Sector Conduct Authority or the FSCA, the Financial Sector Conduct Authority or FSCA has given an update on various market abuse investigations. The FSCA is mandated to investigate and in appropriate instances to enforce actions in case of market abuse on financial markets. Three kinds of market abuses are prohibited in South Africa, namely insider trading, market manipulation, prohibiting trading practices, and false or reporting relating to the affairs of a public company. Our investigation procedures include interviews under oath, acquiring documentary evidence, and obtaining assistance from foreign regulators. In matters of insider trading, the FSCA may order that alleged offender pay an amount equal to the profit made or the losses avoided because of the offending transactions, and a penalty of up to 3 times such an amount. These funds are distributed after recovery of cost to persons who may have been prejudiced by the offending transactions. Also, the FSCA may impose a range of administrative sanctions on the alleged offenders. Market abuse transgressions are criminal offences in terms of the FNA or the Financial Markets Act 19 of 2012. The Director of Public Prosecutions may institute criminal actions against any person involved in these efforts. It is not the function of the FSCA to institute criminal prosecutions, but would provide all information necessary to assist the Director of Public Prosecutions. Since 1999, the FSCA, its predecessor, the Directorate of Market Abuse, and the Insider Trading Directorate investigate a total of 421 cases. A total of 307 cases were closed because there was either evidence or insufficient evidence existed indicate that the FMA or the now replaced Insider Trading Act or Security Services Act was contravened. In 91 cases, the FSCA DMA decided to proceed with enforcement actions. The penalties imposed on offenders to date amounts to approximately 138 million rand. Right, then another role player is associations. And here we have the International Organization for Securities Commission, or the IOSCO. The IOSCO was established in 1983. Its membership regulates more than 95% of the world's security markets in more than 115 jurisdictions. Security regulators in emergency markets accounts for 75% of its ordinary membership. The IOSCO objectives and principles of security regulation have been endorsed by both the G20 and the FSB, or currently the FSCA, as the relevant standards in this area. They are the overarching core principles that guide IOSCO in the development and implementation of internationally recognized and consistent standards of regulation, oversight, and enforcement. They form the basis of evaluation of security sector for the Financial Sector Assessment Program, FSAP, of the International Monetary Fund, the IMF, and the World Bank. By providing high-quality technical assistance, education and training, and research to its members and other regulators, the IOSCO seeks to build sound global capital markets and a robust global regulatory framework. Then we have the Financial Markets Association, or ACI, a leading global association of wholesale financial market professionals contributing to market development through education, market practices, technical advice, and networking events. The ACI is a leading non-profit, non-political association of wholesale financial market professionals. Members of the ACI are in large part engaged in professional trading, broking, operations, regulatory and compliance activities in foreign exchange, money, fixed income, and derivative markets. The ACI was founded in Paris in 1955 as Association Cambiste Internationale, and had a proud and illustrious history of involvement in helping its members through various market interactions. The ACI currently counts some 13,000 international members from more than 60 countries, with a growing interest globally. Then we have the SAIFM, or the South African Institute of Financial Markets, which is a non-profit voluntary association established to promote professionalism and integrity amongst members and the financial market as a whole, and is registered as a professional body in terms of the National Qualifications Act. Then we have exchange. An exchange is a marketplace where securities, commodities, derivatives, and other financial instruments are traded. The core function of an exchange is to ensure fair and orderly trading and the efficient dissemination of price information for any security trading on that specific exchange. The functions of the stock exchange: function number 1 is to ensure liquidity of capital. The stock exchange provides a place where shares and stocks are converted into cash. The exchanges provide a ready market where buyers and sellers are always available, and those who need hard cash can sell their holdings. Had this not been possible, then many persons would have feared for blocking their savings in securities, and then they cannot again convert them back into cash. The second function is continuous market for securities. The stock exchanges provide a ready market for securities. The securities, once listed, continue to be traded at the exchange, irrespective of the fact that owners go on changing. The exchanges provide a regular market for trading in securities. The third function is evaluation of securities. The investors can evaluate the worth of their holdings from prices quoted at different exchanges for those securities. The securities are quoted under the free atmosphere of demand and supply, and the prices are set based on the free market. Stock exchanges help evaluate any securities listed there. The fourth function is mobilizing surplus savings. The stock exchange provides a ready market for various securities. The investors do not have any difficulty in investing their savings by purchasing shares, bonds, etc. from the exchanges. If this facility is not there, then many persons who want to invest their savings will not find avenues to do so. In this way, stock exchanges play an important role in mapping up or mopping up surplus funds of investors. The fifth function is help in raising new capital. New capital and existing concerns needs for the activities. The new concerns raise capital for the first time, and existing units increase their capital for expansion and diversification purposes. The share of new concerns are registered at the stock exchange, and existing companies also sell their shares through brokers, etc. at the exchanges. The exchanges also help raise capital both through new and old concerns. The intending buyers also remain in touch with the exchanges for investing money in securities. The sixth function is safety in dealings. There is no scope for manipulating transactions. Every contact is done according to the procedures laid down, and there's no fear in the minds of the contracting parties. Safety in dealings bring confidence in the minds of all concerned parties and help increase various of the dealings. The seventh function is listing of securities. Only listed securities can be purchased at the stock exchanges. Every company desirous of listing its securities will apply to the stock exchange authorities. The listing is allowed only after critical examination of the company's capital structure, management, and prospects. The listing of security gives privilege to the company. The investors can form their views about the securities because listing securities does not guarantee the company's financial stability. Right, let's have a look at examples of stock exchanges. In South Africa, we've got the JSE or the Johannesburg Stock Exchange. The JSE Security Exchange and the Johannesburg Stock Exchange is the largest stock exchange in Africa. The JSE is presently the 16th largest stock exchange worldwide. Then you get the Bond Exchange of South Africa Limited, or BISA. The Bond Exchange of South Africa, BISA, was a South African bond exchange based in Johannesburg that was acquired by JSE Limited in 2009. Before its acquisition, it was constituted as a public company and was responsible for operating and regulating the debt securities and interest rate derivative markets in South Africa. Then you get the over-the-counter markets, or the OTC market, a decentralized market without a central physical location where market participants trade with one another through various communication modes such as the telephone, email, and proprietary electronic trading systems. An over-the-counter or OTC market and an exchange market are the two primary ways of organizing financial markets. In an OTC market, dealers act as market makers by quoting prices at which they will buy and sell securities, currencies, or other financial products. A trade can be executed between the two participants in an OTC market without others being aware of the price at which the transaction was completed. In general, OTC markets are typically less transparent than exchanges and are also subject to fewer regulations. Then you get your CSD or Central Security Depositories. The Central Security Depository or CSD is an institution that holds financial instruments including equities, bonds, money market instruments, and mutual funds. It allows ownership of those instruments to be transferred in electronic form through an updating electronic records, which are often known as book entry records. The UK CSD is Euroclear UK and Ireland EUI. The Bank of England is the competent authority for the authorization, the supervision, and the policy for the EUI. The basic functions is to maintain the register of security, issuance of the International Security Identification Number, ISIN, for all issues of securities, the clearance and settlement of securities on principal, delivery versus payment, and the provision of additional services to issuers of securities. Then you have the straight transaction totally electronic system or straight system. Straight in South Africa Central Security Depository. It is an FSCA licensed financial market infrastructure that owns the technology to securely hold equities, bonds, and money market securities in electronic form so that buyers and sellers can exchange ownership of these securities once they are successfully traded. Given that records are electronic rather than transferring physical certificates, Straight records a transaction via book entry. The shareholder database held at Straight is recognized as the legal record of ownership in South Africa. Straight is an independent company serving multiple stock exchanges in South Africa as well as their respective issuer clients. It also facilitates corporate actions such as dividends, payments for those issuers, as well as other services in terms of South African legislation. Also, value-added services are available such as collateral management, IT services, and training. It also continues to explore new, advanced, and even disruptive technologies that could be identified as new opportunities in the financial markets. Now, here's just an example of a Straight. The order is placed by stockbroker A for investor A. The bid is then made by stockbroker B for investor B, and then the Straight system will match stockbroker A's investor with stockbroker B as investor so as to put the whole transaction together. Right, let's have a look at clearinghouses. What is a clearinghouse? A clearinghouse acts as an intermediary between a buyer and a seller. Now, I'll put a picture on there for you. And seeks to ensure that the process from trade inception to settlement is smooth. Its primary role is to make certain that the buyer and the seller honor their contractual obligation. Responsibilities include settling trading accounts, clearing trades, collecting and maintaining margin money, regulating delivery of the bought-sold instrument, and reporting trading data. Clearinghouses is to act as third parties to all future and option contracts, as buyers to every clearing member seller, and as seller to every clearing member buyer. After a buyer and a seller have executed the trade, the clearinghouse enter into the picture. Its role is to consolidate the steps leading to the transaction settlement. It's acting as the middleman. A clearinghouse provides security and efficiency integral to the financial market stability. Clearinghouses take the opposite position of each side of a trade, significantly reducing the cost and the risk of settling multiple transactions amongst multiple parties. While the mandate is to reduce risk, the fact that they must be both buyer and seller at trade inception means that they are subject to default risk from both parties. To mitigate this, the clearinghouse imposes margins for initial and maintenance requirements. The future market is most commonly associated with clearing markets since its financial product are leveraged and require a stable intermediary. Each exchange has its clearing house. All members of an exchange are required to clear their trades through the clearing house at the end of each trading session and deposit a sum of money based on the clearing house margin requirements, enough to cover the members' debit balance. Stock markets like the New York Stock Exchange, NYSE, and the Nasdaq have clearing firms. They ensure that the stock trader have enough money in their account, whether using cash or broker provided margin to fund their trades. The clearing division of these exchanges act as the middleman, helping facilitate the smooth transfer of the funds. When an investor sells a stock they own, they want to know that the money will be delivered to them. The clearing firm makes sure this will happen. Similarly, when someone buys a stock, they need to be able to afford it. The clearing firm makes sure that the appropriate amount of funds is set aside for the trade settlement when someone buys the stock. So let's just look at a few key takeaways regarding clearing houses. A clearing house acts as an intermediary between a buyer and a seller and seeks to ensure that the prospect from trade inception to settlement is smooth. In acting as the middleman, the clearinghouse provides the security and the efficiency that is integral for financial market stability. To mitigate and default risks, clearinghouses impose margins, initial and maintenance requirements. Right, that ends our session for this one. We will, in our next session, Unit 2.1, discuss intermediaries, brokers, speculators, and investors. Thank you so much for attending this session. I'll then see you in the next session, Unit 2.1. We will look at intermediaries, brokers, speculators, and investors. Thank you very much.